Welcome to the review session for exam number 4. We are going to start with the practice set, and to find the practice set, remember you need to click on the option that says assignments I can practice now, as opposed to assignments I can take now, because this is not graded. There are 12 exercises in the practice set. Remember, this exam only covers 2 chapters. Remember also to open your textbook before you start the exam, please. And for the purpose of this review, we're going to start with exercise 9 in that practice set, and we'll go 9 through 12, and then we'll go back to the beginning, and we'll use as much time as we can to get through as much of this as possible. Certainly, if there's something on the recording, if you're watching it later, if you have a question on something, if we didn't get to an exercise, you're welcome to check in with me about anything that's in this practice set or anything for the exam. But because we've had a request by someone who's here live, we are going to start with exercise 9. This is from chapter 11 on corporate bonds. And this exercise deals specifically with amortizing the discounts. So remember, we're only using the straight line method for amortizing discounts, and the effective interest method is covered in the appendix, and that's actually a better way of doing it, but it's also more complicated. And so we're going to use the straight line method. That's the only thing you are responsible for knowing. On the first day of the fiscal year, a company issues a $2.5 million 8% 5-year bond that pays semi-annual interest of $100,000. Remember, we also have that page of formulas, by the way. Actually, I think there are 2 pages of formulas and terms in the chapter 11 reference materials. So they received cash of $2.3 million. These bonds were sold at a discount. What that tells us then is that the 8% that we are paying is lower than the market rate of interest for bonds of similar risk. That's why we had to kind of lower the price on our bond issue in order to sell them. So the effective interest rate is somewhere below 8%. We don't need it for this particular exercise because we are using the straight line method. If we were using the effective interest, we would need to know what that effective interest rate was in order to do the calculations. And so the semi-annual interest, we're going to make the payment, and we have to journalize that first interest payment. Now, it specifies first interest payment, but in the straight line method, we know that every interest payment would look exactly the same. That's why it's called straight line. And so when we make that first payment, the payment is for $100,000 worth of interest. And so the credit to cash is going to be for the amount that we actually spent. We actually mail checks for $100,000 to the bondholders. But we have that discount, and how much was the discount? So we have the face value of that bond issue minus the actual cash realized is $200,000. And so that $200,000 represents the discount, the amount we had to lower the price to get people to be interested in buying our bonds that were paying a lower rate of interest. So straight line means we're going to take that $200,000 discount, and we're going to amortize the same amount every time we make an interest payment. So how many interest payments are we going to make? Well, it's a 5-year bond. We pay semi-annual interest, or interest twice a year. So we're going to make 10 interest payments. So they make this math nice and simple for us. A $200,000 discount being amortized in a straight line, or the same amount each time. We're going to be amortizing $20,000 every time we make an interest payment. So the discount has a normal debit balance. So to amortize that, to get rid of it gradually over time, we need to credit that account, and we're going to credit $20,000 each time we make a payment. And so the interest expense that we record is, really, if we look at this entry, it's the amount we need to make this balance. So why are we recording more interest expense than we're actually paying? Because as we said, the interest we are paying is 8%, but that's less than the market rate of interest. So we have to record more than that to reflect the actual cost of borrowing. And so each time we record interest, we are using up or amortizing a little bit of that discount, and that reflects our true cost of borrowing. So we're just allocating that discount over the entire life of these bonds. So as we have done before for these review sessions, of course, if you have a question, you're welcome to unmute. If nobody says it, or put it in the chat, if nobody says anything, I will assume that everybody's good and we'll just keep going. So if we were amortizing a premium, it would be exactly the opposite. The calculations would look the same. How much is the premium? How much did we get paid over and above the face value? And then we would divide that by the number of interest payments to find out the amortization of the premium. But premiums, of course, have a credit balance. And so we would need to debit those accounts. And that would actually reduce the interest expense that we were reporting. So exercise 10 has us issuing bonds at a premium. So we know that the interest that we are paying makes our bonds more attractive. It is a higher rate of interest than the market is demanding for bonds of similar risk. So on the first day of the fiscal year, a company issues a $6 million. That's the principal or the face value. 6% is the face or stated interest rate. This is a 5-year bond, and it's paying semi-annual interest of $180,000, and it shows you the calculation. Again, those formulas are in Brightspace in the reference materials folder. The face value was $6 million, but we received $6.3 million. So when we sold them, the bondholders were willing to pay us a bit more because our 6% interest made these bonds more attractive than other bonds of similar risk. And so we were able to capitalize on that to make a little bit of extra cash, if you will. On our balance sheet, though, the bonds payable account always must be reported at the face value, because that's the amount that we are required to repay when these bonds mature in 5 years. And the difference between those is the premium amount. And again, the premium is the amount that we need to make this entry balance. It's the extra that our bond purchasers were willing to give us because our interest rate was more attractive, was higher than other bonds of similar risk. And so if we were issuing bonds at a discount, again, kind of the reverse would be true. We would record the cash, which would be less than the face value. And so to make that entry balance, we would need a debit for that discount amount. And so that's what issuing bonds at a discount would look like. Similar, but debit balance on the discount rather than a credit balance on the premium. And so when we did exercise 9, I kind of alluded to what this would look like. When on the first day of the fiscal year, a company issues a $6 million, 6% 5-year bond. So this is the same bond that we just recorded the issuance of that bond in exercise 10. We have a premium we already recognized in exercise 10. The premium is $300,000. If this is a 5-year bond and it's paying semi-annual interest, we have 10 interest payments. And in those 10 interest payments, we need to fully amortize that premium. So to do it in a straight line fashion, we are going to amortize $30,000 of that premium each time we make an interest payment. So since we have done exercise 10 already, we have that premium. I can show you, we have that premium that's a credit balance. So to get rid of that, we will need to be debiting that premium account for $30,000 each time. $30,000 every 6 months over the 5 years. At the end of the 5 years, when we make that final interest payment, the premium will be completely amortized. It will be down to zero. And then when we pay off the bonds, we pay just the face value, which is now equal to the carrying value. So the carrying value of the bonds is the face value plus any premium that's still there, or minus any discount that we're still showing. This is the interest payment though. And again, this exercise says first interest payment, but since we're using the straight line fashion, every interest payment is going to look exactly the same, which is we credit cash for the amount we're actually paying. We amortize the premium or discount in a straight line fashion, and the interest expense that we report is whatever we need to make this entry balanced, that our debits and credits are equal. So exactly the opposite of what we saw in exercise 9. In this case, when the bonds are issued at a premium, the interest expense that we report is less than we're actually paying, because our effective interest rate is lower than our stated interest rate. We agreed to pay 6%, but the market doesn't require 6% for a bond with a risk like ours. And so the interest expense that we report on our income statement looks lower, or is lower, than the actual cash flow. All right, so let's keep going. Get my writing off the screen there. We'll move on to the final. So here we are at the end of the life cycle of the bonds. We have a $2 million bond issue on which there is an unamortized premium. So that's a remaining premium of $87,000. And in this case, because we know that there's a premium left, we know that we're not at the end of the life cycle of these bonds. We're somewhere in process. And this company decides, rather than continuing to pay the interest, for some reason, they are going to retire them early and they're going to pay them off. They save those however many interest payments there are. And rather than having to pay the full face value, they're going to pay something less than that. So we're going to work through this one piece at a time. So one thing we know that happens is that we have to use cash to buy these bonds back, to pay them off, to retire them. It's kind of like paying off a loan early. It's really what we're doing here. So since we're paying off those bonds, we need to remove the bonds payable from our balance sheet. We no longer will have that liability showing on our balance sheet. If you think about it, what we've already covered today, when we sold those bonds, even though we sold them at a premium, the amount that we recorded in the bond payable was the face value. And so we need to get that off our balance sheet, because we no longer, after this payment, we no longer will owe those bonds. We're also not going to be paying any additional interest on these bonds. So we know that the bond premiums have a credit balance. Since we no longer have those bonds, we also need to get rid of that remaining bond premium. Since it has a normal credit balance on the premium, to get rid of it, we need to debit that account. And so now we will have removed from our balance sheet not only the face value, but also the remaining premium. I'm going to have to do a little bit of math here. I can see, of course, that our debits and credits are not equal, but I have to do the calculation. I'll put it on the screen so everybody can see it. I have to do the calculation to determine how much we are out of balance at this time. And so that's the calculation I'm doing. 2 million plus the 87,000. So that 2,087,000 represents the carrying value of these bonds at the time that we retired them, at the time that we paid them off or redeemed them. So that's how much they're worth on our balance sheet. And if I subtract the amount we actually had to pay, the difference is $127,000. So if the carrying value, if our books are showing that we have a liability of $2,087,000, but we only have to spend $1,960,000 to retire those bonds, that's a gain. That's a win for us, right? We didn't have to pay off the full amount of that bond issue. So let's think just for a moment. It's not part of this exercise, but let's think just for a moment. Why would we be able to redeem those bonds for less than what we're carrying them on our books? Well, think about what we talked about in class, that there is an inverse relationship between bond prices and interest rates. The price of these bonds must have fallen. That's what makes it so that we can buy them back for less than their worth on our balance sheet, less than our carrying value. The bond price must have fallen, which we know means that interest rates must have increased. If interest rates increased, our bond that was pretty attractive is no longer as attractive. People can get a higher interest rate by buying someone else's bond, so ours doesn't look as good, and that makes the price fall. I'm simplifying, but hopefully you get the idea. And so for this company, while prices are lower because interest rates are climbing, if they have the cash available, they absolutely can go out in the open market, just like you or I could if we wanted to buy something at a bargain price. We just go out and buy it. They don't necessarily contact the bondholders and say, hey, do you want to sell your bond? They go into the market and they just buy up what's there. In chapter 12 that we started this week, by the way, we'll be talking about treasury stock and how a company might buy back some of their own stock, and it's kind of a similar process. Okay, so we did exercises 9 through 12. We're going to go back. Let's just go back to the beginning of the practice set, and we'll pick up there. And so we've gone back to chapter 10, which is the liabilities other than corporate bonds. So we talked about a lot of different types of liabilities in this chapter. And our first exercise is related to notes payable. On January 26, Nairi Company borrowed cash from Conrad Bank by issuing a 45-day note with a face amount of $300,000. Assume 360 days in a year. The first thing we're asked to do is determine the proceeds of the note, assuming the note carries an interest rate of 6%. By the proceeds of the note, they simply mean how much did Nairi Company actually receive when they issued this note. Well, they would have received the full face value of that note, $300,000. But Part B, what makes Part B different is it tells us the note is discounted at 6%. And that means that the interest is calculated upfront and subtracted to determine how much are we actually going to, the bank, how much is Conrad Bank actually going to give to Nairi Company. And to calculate that, we're going to use the same formula, the simple interest formula, I equals PRT, principal times rate times time. And we just need to make sure that our rate and time are in the same terms. So to do this calculation, to find the interest, we start with the principal, the 300,000. The interest rate is 6%, we are told, and the time is 45 days, but we need to express that time as a portion of the year because the interest rate is an annual interest rate. It tells us to use 360 days in a year, and I think they do that simply because it makes the computations slightly easier, maybe a little bit less needing to round any answers that we get. And so when I plug that into my calculator, I find interest of $2,250. Now, whether the note is in part, like in Part A, where the interest is on top of the face value, or if it's like Part B, that the note is discounted, the interest is actually the same. It's still that $2,250, but when the note is discounted, that $2,250 is subtracted from the face value, so 300,000 minus $2,250, and the proceeds from the note would be only $297,750. Again, I subtracted the interest to find the proceeds of that note. So if you were a borrower, you would rather not have the note discounted, because again, you pay the same interest, but it's on a lower amount of money in Part B than in Part A. So same interest on a higher amount of money means that the effective interest rate on the discounted note is actually a little bit higher than on the regular note, the non-discounted note. All right, and we'll keep going. Again, if you have any questions, make sure you ask while we're going through this. In class, we did some of these calculations, and we definitely talked about how Social Security and Medicare is calculated, the 6.2% for Social Security, 1.45% for Medicare. We talked about the cap on Social Security, wage base. We talked about the surtax for upper income earners for Medicare. We talked about how federal withholding is calculated based on number of exemptions and your overall expected earnings for the year, because the federal income tax is progressive. It is not a proportional or a flat tax. We also talked about some additional categories that might be withheld from your paycheck, including things like retirement savings or contributions toward benefits such as health insurance, maybe some charitable contributions to United Way or something else like that. So this exercise is much simpler than what we did in class, because we don't have to do any of those calculations. The dollar amounts are all provided to us there, and we are asked to journalize the entry to record the period's payroll. So the payroll register shows that our employees had earned $80,000 during this period. And so we're going to start out by recording that full $80,000 as salary expense. That's what's going to show up on our income statement. But we don't actually pay the full $80,000 to our employees because of these withholding amounts. So let's just go through those. We start with Social Security of $4,800. You'll notice that's a payable, and that means they're withholding it from the employees and paying it into Social Security on their behalf. In class, we also talked about the fact that there's an employer match to that Social Security. So it's not part of this entry, but there would be a separate payroll expense, payroll tax expense entry where the employer reports its obligation to match this $4,800. Same thing for Medicare. We're not reporting it as expense here, but we are withholding it from our employees' paychecks, and we will remit that to the federal government at the proper time, and Medicare is matched just like Social Security. We then have some federal income tax, and that is also a liability. We're keeping it out of our employees' paychecks, but we are only doing that because we are going to send it to the federal government on their behalf. And so that's based on the frequency of pay, the amount we're forecasting you earn throughout the year, how many exemptions, and that kind of thing. So we showed those withholding tables, at least one version of the withholding tables. And what retirement savings withheld. And so that money is going to be sent to whoever is the custodian of our retirement funds, the 401k or 403b or whatever. We are keeping that out and depositing it into those investment funds on our employees' behalf. And so the actual amount that we're going to pay And so this doesn't say we're paying it, it just says to record the payroll. So if we are actually making the payment, the credit would be to cash, but it doesn't say we paid it, it says we're recording it. And so I'm just going to put salaries payable. If it said we paid it, we would be crediting cash here. So they earned 80,000, but we're not actually going to pay them 80,000. You will note that the company will end up paying out the full 80,000, but it just doesn't all go to the employees. So to find out the net pay, the amount that actually goes to the employees, we took the full amount, the gross pay, and subtracted all of those withholding amounts. Again, all of these are payable, so the company is actually paying out the full 80,000. It just doesn't all land in the employee's check. Okay, let's keep going from there. So this is that entry that I already mentioned, that there would be a kind of a matching entry for the payroll tax. And so this is the same company, the same as the previous exercise, and this entry that we are about to record in exercise 3 is the supplemental entry. It's the rest of the cost to Heritage Company. And so they're going to be reporting that they have to match that Social Security, as I mentioned in the previous exercise. They have to match that Medicare payment of $1,200. Earnings of $14,000 are subject to state and federal unemployment compensation taxes at a rate of 0.8% for the federal and 5.4% for the state. So not all of the earnings, not all of the 80,000 is subject to unemployment. Only 14,000 is subject to unemployment. And you'll notice that we didn't do anything on the employee side on the first entry we did. We didn't do anything related to unemployment. Unemployment is paid completely by the employer, not, there's no contribution part by the employee. So for the state, the rate is 5.4%. So 5.4% of the wages that are subject to unemployment, which is 14,000. So 5.4% of 14,000 is $756. And then we're going to do the same calculation, 14,000 at 0.8% or $112 for the federal unemployment. And all of this is going to be reported as the additional payroll tax expense. We kind of lump all those things together under one umbrella as far as the expense side goes. And so on top of the 80,000 that they're paying to the employee, and for all of those, the employee side, the retirement, Social Security, Medicare, and federal withholding, and in 42 of the 50 states, there would also be state withholding for state income tax. This is on top of that. So the total cost for this payroll to the company is not 80,000, but 86,868. What did I leave something? Sorry, I need to go back. It looks like they didn't get full credit on something, and I'm not sure. I don't see anything that's missing there, but it looks like they didn't give me, I didn't get full credit for that exercise, and I didn't notice that, but now I see that my score is not full credit, but I don't see anything that's missing. I'm looking at the check marks, and it does look like exercise 2 is the one that they're not granting full credit. And I don't see anything else there. So I have no idea what it thinks is missing there or what. But I have no answer to that. I don't see anything missing. So as we move on then, again, if you have any questions, of course, stop me. But as we move on to exercise 4, vacation pay and pension benefits. Regling Company provides its employee vacation benefits and a defined benefit pension plan. So we spent some time in class talking about the difference between defined contribution, where we know upfront how much is going to be put in to the account for us, but we don't know how much it's going to be worth when we start withdrawing from our retirement. That's kind of the new style of retirement planning. The defined benefit, where the company says, here's how much we'll pay you when you retire, that is really the old style of pension, and very few companies still do that, in part because it's really hard to account for that, because there's so many estimates or projections involved in those calculations. So it is much cleaner to use a defined contribution plan. It's also benefits workers who can take that with them to their next job. Defined benefit works really well for the old style of work, where you might go to work right out of high school or right out of college and work for that same company for 40 years before you retire. And that's definitely a much less common event today. So in this exercise, we're told employees earned vacation pay of $25,000 for the period. The pension formula determined a pension cost of $139,250. Only $105,000 was contributed to the pension plan administrator, which means that there's an unfunded piece to that. And so letter A is for the vacation pay. So this is how much they earned this period. So we're going to report the expense associated with that. The reason we have to report it in the period it was earned is because of the matching principle. So we shouldn't be reporting the expense when they're taking vacation, because when they're taking vacation, they're not helping us to make money, which is our definition of an expense. So we need to report that expense when they're actually working. And so we calculate, we estimate how much that's going to cost us. And then on our balance sheet, we set aside that value so that when our employees are actually taking vacation, we're not reporting expense at that time. We've already reported the expense as it was being earned. And then when we pay them vacation, we reduce this remaining liability. So the debit would be to vacation pay payable to reduce that liability, rather than to vacation pay expense when the workers are actually on vacation. Part B then is the pension part, and we need to report the pension. Because this is a defined benefit pension plan, it's again more complicated to calculate, but we have used the predictions that we have to come up with that expense of $139,250. Again, that needs to be reported at the same time that our employees are actually performing the work, performing the service for us, that's making them eligible for that pension. And so we are accruing it, we're recording it while they're working. They made a contribution of $105,000 to the pension plan. And so that's a use of cash, a credit to cash. And we still need to balance this entry. So the difference would be $34,250. And that represents the pension liability that has not been funded. And so companies are now required to report the pension that they anticipate needing to spend, that they're not setting aside at this time. And so keep in mind that these two entries that we did are based on what's being earned right now. These entries are not for what might be being paid out, both for vacation and for pension for people who are already working, or excuse me, people who are already retired or on vacation. I didn't mean to say already working. Okay, so we've spent some considerable amount of time really talking about the notes and notes payable and calculation of interest. So we saw during chapter 10 that installment notes are very similar in that we calculate simple interest, but we're making routine or regular payments toward that note. So we're paying down the note. And so each time we make an entry, each time we make a payment, the interest is going to be a little bit less because we're reducing that principal each time we make a payment. On the first day of the fiscal year, a company issues $45,000 8% 6-year installment notes that have annual payments of $97.34. The first note payment consists of $3,600 in interest and $6,134 of principal repayment. So where did that $3,600 of interest come from? We would have used the simple interest formula, I equals PRT, 45,000 times 8% times 1 year. That should be the $3,600 of interest that we owe at the end of that first year. The rest of that payment then goes to reduce the principal. And so next year when we make our second payment, the principal is lower, so the interest that we owe will be lower and the principal that we repay is higher. So journalize the entry to record the issuance of the installment notes. So the actual borrowing, we borrowed $45,000. That's the face value, and it doesn't tell us that it's a discounted note. So we borrowed $45,000 and we now owe $45,000. Now we get to the end of the first year. We've had that $45,000 to use for the year, and we now owe 1 year worth of interest. So the interest expense is already calculated for us, but we know how to calculate that using the simple interest formula, I equals PRT. The amount that we are going to pay is $97.34. Again, that was already given to us in this exercise. And the difference between the amount that we paid and the amount of interest that had accrued since we took out this note represents the payment toward the principal. And so let me just do that calculation. We paid $97.34. Oh, I think it gave us that number. Sorry, it gave us that number right here. I don't have to do the calculation. So it would have been easy to do that calculation. It's how much did we pay? The first $3,600 goes toward interest, and whatever's left goes toward reducing the principal. And so the next interest payment, the cash would be the same, but the interest expense would be lower because we owe less, and so the principal repayment would be actually higher at that time. And so that's how it goes as we make each one of the 6-year notes, and so or 6-year payments, excuse me. And so when we make payment number 6, we pay off the remaining balance on the note and the interest for that final year, which is going to be much lower than the $3,600 that we had to pay the first year because the balance is lower. Okay, the last exercise from chapter 10 on other liabilities is estimated warranty liability. So it's important to note that similar to the pension and the vacation, we don't know exactly how much this is going to be. So we have to predict or project, estimate how much we might actually end up spending to satisfy any warranty claims. Qantas Industries sold $325,000 of consumer electronics during July, and those electronics had a 9-month warranty. The cost to repair defects under the warranty is estimated at 4.5% of the sales price. So if I do that calculation, so if our sales were $325,000 and we estimate that we're going to incur an additional cost of 4.5% of that amount, that is $14,625 that we estimate we're going to end up spending on warranty work, replacing or repairing defects under the warranty. And so again, the matching principle says if you're going to incur expense associated with this sale, you need to report that expense in the same period that we report the sale. We don't know in the month of July how many of these electronics are going to need to be repaired or replaced over the next 9 months, but we have to estimate. So what do? We look at what's happened in the past, and in this case, we estimate it would be 4.5%. That's based on what happened, last year or the last 3 years or whatever. And so we report the expense in the same period as the sales, and we set aside this. It's not separate money. It's not in a separate bank account or anything like that. It's just recognizing the future cost that we expect to incur. So we're setting aside that value on the balance sheet as a liability, but it does not mean that we took $14,625 and moved that actual cash into a separate, bank account. That's not how this works. On November 11th, the customer was given $220 cash under terms of the warranty. And so in Part B, we're asked to journalize that payment. I'm not sure why we're paying them cash as opposed to just repairing the defects, which is what it says, but maybe it was a refund, maybe it was not repairable. And we said, here's your money back, go buy a new one. Either way, apparently it's the terms of the warranty, and so I'm not arguing about that. We have to journalize what we're given here in the exercise. So we spent $220 in cash, but remember, we knew back when we made the sale, whenever that was, it could have been up to 9 months ago that we made this sale. Oh, so that's on November, sorry. It could be anytime from March to November that this sale happened. And at the time, whenever that sale happened, we had already estimated that there was a risk that that particular consumer electronic would need to be repaired or replaced, or apparently given money back. And so at that time, we had set aside this product warranty payable. And now that we are actually refunding somebody's money, we're reducing the remaining payable. So again, the expense gets reported at the same time as the sale. So it has to be an estimate because we don't know how many of these are going to break or need to be repaired over the next 9 months. And once we actually do incur some cost, then that means that the remaining estimated cost is going to be lower. So that's the end of the review from Chapter 10. We have a couple more exercises for Chapter 11. So the first one is issuing bonds at face amount. So we said in class when we did an exercise similar to this, that's not very common, very extremely unlikely that we would issue them at exactly face value, but it certainly does make our accounting easier. On January 1st, the first day of the fiscal year, Designer Fabric Incorporated issues a $5 million 6% 10-year bond that pays semi-annual interest of $150,000. They received $5 million in cash. They sold them at face value, or at par is the other term that we used in class. In letter A, we're asked to journalize the entry to record the issuance of the bonds. So we sold these bonds for cash. We have a bunch of cash that we did not have before, but we also have a liability, a long-term liability. These are 10-year bonds. So we have a long-term liability that in 10 years, we have to pay back that face value. And so that's what we record in bonds payable. As I said earlier, the bonds payable account always has to be the face value, even if they're sold at a premium or discount. Because there is no premium or discount, it makes journalizing the interest payment simpler as well, because the interest expense that we report is going to be exactly the amount that we pay. And so that calculation for simple interest has already been done for us. It's $150,000. We report as expense, and that's how much we pay. And now fast forward 10 years later, and we are going to pay off the bond. So we would have to make one final interest payment, the 20th interest payment, and that interest payment would look exactly like letter B. And at the same time, we would pay off the face value of the bonds. So we're going to remove that bond payable from our balance sheet. We don't owe that anymore. But why do we not owe it? Because we paid it off. So that's definitely the most basic approach, where there is no premium or discount. And our last exercise in this set is issuing bonds at a discount. So we've already at the beginning of this recording covered issuing that at a premium and recording in the amortization of the premium or discount as we pay interest using the straight line method in exercises 10 and 12. So our last scenario here, issuing bonds at a discount. So we know that bonds would be issued at a discount because the interest rate we are paying is less than the market rate of interest for bonds of similar risk. So on the first day of the fiscal year, a company issues a $2.5 million bond, and we received cash of $2.3 million. This is the same bond that we already covered in chapter 9, or sorry, not chapter 9, in exercise 9, where we reported that interest payment. So we've already seen this bond, but because of starting in exercise 9, based on the request from one of the people who were here live, we've already seen the interest payment. So when we sell it, when we sell this bond issue, we receive cash, of course. That's the whole point of selling the bonds, is we're trying to raise some financial capital here. So we report the cash at how much we actually received. But when these bonds mature in 5 years, we will have to pay back the full, whoops, no extra zero there, the full face value of the bonds. And so that's always must be recorded in the bond payable account, is the full face value. And the premium or discount is the amount that we need to balance this. We know they sold at a discount because they sold for less than face value. Discounts always have a debit balance. Premiums, on the other hand, always have a credit balance. And so we have made it through the entire practice set for exam 4. It didn't even take the full hour. So I'm going to stop the recording there, but if you're watching the recording and you still have questions, please reach out. Let me know how I can help.